Look, the traditional luxury real estate market usually limits owners to two really rigid tracks. You're either endlessly chasing stressful transactional quick flips, or you're stuck with low-yield, incredibly hands-on management. But today, we're analyzing massive, high-value assets to show you a third door. It's a highly sophisticated approach called asset governance. And to be clear, this isn't about running some exhausting side hustle. It's about engineering true institutional systems.
We've got to start by addressing a pretty painful reality. Think about those multi-million-dollar investments that were supposed to bring you ultimate financial freedom, but somehow they turn into exhausting 2 a.m. guest texting nightmares. Industry insiders actually call this the luxury ownership paradox. On paper, your asset looks totally effortless, but in real life, you're glued to your phone at all hours, just trying to keep the whole thing from falling apart. If your calendar is packed, but your bank account and your peace of mind really aren't reflecting that success, well, you don't own an asset yet. You just own a very expensive job in disguise.
So here is our roadmap for the next few minutes. We're going to cover the luxury ownership paradox, the STR tax loophole, data-driven dynamic pricing, conquering physical entropy, and finally, the asset governance solution.
Section 1, the luxury ownership paradox, diagnosing the core problem.
There is just a brutal contrast between the dream of owning a sweeping coastal property and the stressful reality of being a reactive commodity host. Standard property managers usually take a whopping 20% fee, right? But their model is entirely reactive. They literally wait for a system to fail or a guest to complain, and only then do they scramble to fix it. To justify those high fees, they push to keep your calendar completely packed, often heavily discounting your nightly rates just to get bodies in beds. But here's the thing. Filling nights at a massive discount directly reduces your actual net operating income. You end up absorbing all the operational risk while your property's premium reputation just slowly erodes away.
And all that volume brings us to a hidden danger. If you're just out there chasing occupancy, you suffer from an invisible margin bleed. We're talking about losing up to 5% of your equity value annually just due to physical entropy. And we're not talking about a massive burst pipe here. We're talking about the swelling door frames that jam up a smart lock, the strained HVAC systems, the scuffed floors from endless rapid-fire turnovers. When you operate as just a commodity host, this physical entropy layer literally eats your margins alive. Section 2, the STR tax loophole, turning real estate into a tax shield. Let's look at the resale tax trap versus deed governance. Take Ryan Serhant's recent $12 million luxury penthouse flip, for example, with an expected $2 million net cash spread. That kind of transactional flipping creates an immediate, massive short-term capital gains liability. But what if you retain that deed? By utilizing the short-term rental tax loophole, something Stephan frequently references, to offset active income, you can govern the asset instead. The crucial point here is meeting two strict IRS requirements. First, keeping your average guest stay to 7 days or less. Second, logging at least 100 hours of material participation, meaning you're actively managing the property. Hit those two, and the IRS treats your property as a non-passive business. This is massive because you bypass passive loss limitations entirely. Underwrite that penthouse at $1,500 a night with an institutional 65% occupancy floor, and you secure $300,000 a year in recurring cash flow, completely hands-off. The true power of this loophole really shines through accelerated depreciation. By utilizing a cost segregation study to identify 5 to 15-year property components, think plumbing or specialty lighting, you can shrink traditional depreciation timelines from 27.5 years down to just a fraction of that. When you combine that with bonus depreciation, you can potentially create massive paper losses that wipe out 6-figure tax liabilities on your active income. It completely transforms the baseline profitability of your asset. Section 3, data-driven dynamic pricing, capturing peak revenue. Let's pause here for a real portfolio diagnostic check. Look at your current holdings. Are your properties optimized strictly for transaction velocity, or are you capturing every ounce of monthly net operating income? Let me know in the comments below. Are you positioned for transactional gains or sovereign yield? Because strategic vacancy is actually a tool. Leaving certain nights empty protects your asset from wear and tear while maintaining its premium market positioning. This is the premium executive underwriting shift. Look at how Robuilt builds spectacular modern mountain cabins for $800,000, usually looking to flip for a quick $300,000 gain, or how Meet Kevin acquires high-end multifamily buildings, expecting standard $2,000 a month long-term leases. But when you pivot those properties into corporate-facing executive suites and luxury retreats, the yields fundamentally change. Elite algorithms look for micro-seasons, like a sudden biotech conference, to spike rates, while enforcing strict floors. At $800 a night with algorithmic dynamic pricing curves, those cabins and suites easily command $10,000 to $18,000 a month each. You're scaling your cap rates while completely avoiding traditional tenant liabilities.
Moving right along to Section 4, conquering physical entropy, delivering rational certainty. Think about ancillary curation and carrying cost neutralization. Enes Yilmazer tours these spectacular $100 million Bel Air mega mansions that sit completely empty 10 months out of the year, just bleeding millions in carrying costs. Meanwhile, Codie Sanchez recently highlighted a corporate event space grossing $20,000 a month through manual venue rentals. By layering institutional-grade automated concierge software, you protect these properties and maximize their value. You introduce NDA-bound automated check-ins for corporate elites, luxury transit packages, and private wellness add-ons. You de-risk the asset, totally eliminate manual scheduling, and effortlessly double that revenue to $40,000 a month with zero extra wear on the property. And this brings us to one of my favorite concepts. Industry insiders call it the squirrel paradox. Basically, you can easily use an API to automate a digital smart lock, but you absolutely cannot API call a squirrel that decides to stuff walnuts into your HVAC vent. Physical reality is just messy. That's why elite operators use thermal IoT sensors to catch a half-degree temperature creep in a blower motor. It allows for a cheap $50 fix on a slow Tuesday before it ruins a $10,000 weekend booking. The guest never knows, the owner never knows. That is true invisible management. Finally, Section 5, the asset governance solution, engineering institutional systems.
By anchoring your strategy in capitalization rates and net operating income, you elevate your property into a professional, data-backed financial instrument, one that tracks directly alongside U.S. institutional REITs. Asset governance means you stop treating your luxury property like a casual, exhausting side hustle, and you start governing it like a flagship commercial asset. It's all about capital allocation, long-term asset optimization, and ensuring the property is completely exit-ready from day one.
You don't need to trade your personal time to run elite estates. You can take this step-by-step systems manifest and connect your own smart software APIs, or you can delegate the entire operational design to our white glove team. The choice is completely yours. Tap the link below to get started. But I'll leave you with this final thought. Are you going to keep babysitting a building, or are you finally ready to govern your wealth? Thanks for joining this explainer, and we'll see you in the next one.